In today's episode, I'll be considering the fourth and final technique that's in scope for this mini-series to help achieve the benefits of portfolio diversification. And that's using the technique of trading strategy diversification. Now this is particularly useful because it should provide a level of risk management when other diversification techniques don't. And so wherever possible, this should definitely be considered as a component of your overall portfolio diversification strategy. Stay tuned. So this time we consider the fourth technique, which is using trading strategy diversification. And this follows on from the three other techniques that we've already covered in previous episodes around asset class diversification, diversification within asset classes, and thirdly, diversification across time frames. Now, the important thing to realise is that when you do diversify across multiple trading strategies, you'll get maximum benefit when each of those individual trading strategies is based on a different premise. So for example, if you happen to have two different trading strategies, but they're both based on a mean reversion premise, then unfortunately this will only provide minimal risk reduction, because each of those strategies will still be taking trades at the same time and probably in the same direction. However, if the two trading strategies that you're trading are based on a mean reversion strategy alongside a trend following strategy, then this will lead to much more effective diversification because those two strategies will be uncorrelated, and they should be taking completely uncorrelated trades. But if we're already diversifying across different assets and time frames, then do we really need to also diversify across trading strategies? And my opinion of this is that yes, there are definite advantages of doing this. And the reason for this is because when you diversify across different assets, the value of that diminishes in certain circumstances. And as we saw in a previous episode, one of those is within financial crises, and the other is due to simple randomness, which results in a pseudo correlation. And in both of these circumstances, they lead to assets exhibiting correlated behaviour for a period of time. And as we already know, correlation is the enemy of diversification. Diversification simply does not work when the individual components are highly correlated. And when one of these situations is in play that does lead to correlated behaviour, that's when the real value of trading strategy diversification comes into play, because the behaviour of the trading activity from this technique can still provide benefits even when the other types are not. So just like we have for other techniques, let's now take a look at this. So what you see on the screen here are the results from two of my own systems, one of those based on a mean reversion premise and one based on a trend following premise. And what you'll notice here is that if we look at the mean reversion strategy on the left, as this was going down in this drawdown that you see here, the equity of the trend following system was actually rising. And equally, when the trend following system was taking a big hit, as you see here, that's when the mean reversion system was doing quite well. And that, of course, is the whole point of trading two strategies in the same account. And when we do that, this is the result that we get. So we can see that both of those drawdowns that we mentioned have now been reduced. And by taking a look at specific metrics around this, we can see the results for the mean reversion strategy here. And so we've got the compound annual growth rate at the top, the maximum drawdown here, and then the combined metric of reward over risk. We've got the same for the trend following strategy, and over here on the right, we have the metrics for the combined portfolio of both of those being traded together. And the CAGR value for that combined portfolio lies somewhere between the other two, which is what we would expect. But the drawdown has reduced significantly in this case, and it's now just 3.9 as opposed to 6.5 and 7.3. But the main advantage of doing this can be seen when we look at the combined figure of 0.8 as compared to 0.59 and 0.27. So the overall improvement of trading these two different strategies in the same account is fairly significant. So let's take a look now at the Darwinex platform again and focus in on a Darwin that is using this specific technique. And the Darwin that I want to focus on today is ZCD. And we can see here that the trader has put a description of his system, and we can see that he is trading a range of price channel, price action, breakout systems, momentum and mean reversion systems. And as this trader says themselves, this is for the reason of minimizing risk and drawdown. And as we can see here, this has led to fairly good consistent returns year on year by this particular trader. Now I thought it would be useful to look at the distribution charts and explain a little bit about how these operate. So the top one here is a daily return distribution and the bottom one is a weekly return distribution. So this gives an indication in the top of how many days tend to be profitable with a profitable return, and the red bars indicate those days that are loss-making. So clearly what we're looking for here is more green than red. Now these bars get automatically categorized in terms of what the range of returns is for a trader. So in this particular case, you can see that this bar is for returns between 0 and 0.48% on a daily basis. And so the corresponding red bar here is for returns that are between 0 and minus 0.48. So what we're looking for is for this bar, ideally, being larger than this bar, because that means there are more days that are profitable for those particular ranges. Likewise, as we move outwards, we're looking for this bar here, where we can see there was 76 days with a range of 0.48 to 0.96% return, being bigger than this one that we see here for the corresponding negative values. And it's exactly the same on the weekly distribution chart. And this indicates that overall, this trader has more profitable weeks than they do losing weeks. And so this is just another one of the many metrics that are on the Darwinex platform. And don't forget, if you have a trading account with another broker, you can still link that account into the Darwinex platform to get these kind of metrics for yourself. Okay, so we've now covered all 4 techniques, and next time we're going to move on to the topic of how much diversification is too much. Or is it simply better to attempt to diversify as much as possible? Okay, so please do remember to give me a thumbs up if you've got value from that, and do make sure that you subscribe so you get notified when that next episode's out. But now until next time, trade safe.